Yes, sure. So first part we have understood about the theory, about what is the definition and all. So derivative, we'll keep it pending because we'll cover it later, own use exemption and all. Right now I don't want to feed you with everything. So now we will look into certain questions which may appear for your exam. Practical questions will sit and solve now. Theoretical question, okay, right? I can discuss, right? Theoretically, and I'll give you printed copy also, so that when you practice, and I'm giving you the way it should be written in the examination. Something, because we know, I also know, you also know institute, because they will confuse you with the language, with the formats. I will keep it maintained just meant for the exam. You read it, you understand it. Okay, first question which has appeared in your MTP. You wish this question should come in your exam, but if it comes, it will come only for 4 marks. And 8 points they are going to give you. They may twist, they may add something extra also. Which of the following would meet and not meet the definition of financial instrument and fall outside the scope of Ind AS 32? First thing, cash deposited in a bank. Financial instrument? Okay, they didn't ask, did he ask you financial asset or liability? Be careful. There can be a variation of the question, so you have to write. They may ask you reason also. It's a plain question. What is cash? Financial asset? No, financial instrument? Yes. Gold deposited in a bank? Not financial instrument. Trade receivable? Financial instrument. Investment in debt? Investment in equity? Prepaid? Why? No contract. Did they ask you in this question? Reason? No, not required. No. See, understand the verb here. They didn't tell you the verb also, in fact. Intercorporate loans and advances. Why? Why it's not a financial? What is intercorporate loans and advance? That means there is a parent and a subsidiary. Parent has given one deposit to the subsidiary. Is it a financial instrument? A parent, say MRPL and ONGC. Who is parent? ONGC is parent. MRPL is its subsidiary. Now ONGC has given one loan to MRPL. Is that loan a financial instrument? Yes. Why? Because for ONGC it is a financial asset, and for MRPL it is a financial liability. They have got a contractual obligation to pay cash, and ONGC has got a contractual right to receive cash. Can MRPL say no, I will not pay? No. Clear? Not because you look at from, okay, have they told you? No. No, but the question is, whose perspective I should look? Not required, because they asked me, is it a financial instrument or not? If it's a financial asset or not, then you need to look from whose perspective. But when you talk about an instrument, then you need to look from the total perspective. Because from the giver's perspective, it should be asset for him. From receiver's perspective, it should be liability or equity for him. Tax deferred revenue? No. Tax liability? No. Tax liability has got a right to receive, income tax department has got a right to receive cash. And you have got an obligation to pay cash. But there is no contract, no. Otherwise, it will fulfill the definition. Provision for estimated litigation losses? No. So if this question comes in the examination, you have to just say which is applicable, which is not applicable. So financial instrument, not a financial instrument. But be careful, I am not sure what they may ask you. They said meet, not meet, fall outside the scope. What they mean to say, I'm not sure. Okay, let us wait. Let us see what they will ask you. Okay. Next, we will go to the financial assets. Okay, to go to the financial assets definition, what they asked you, evaluate whether the following items are financial assets or not. Now you have to look from the person who is investing. So first thing is investments in bonds and debenture. Is it a financial asset? Now, should you write the reason, or will you write in this format only? Why? Why? Because they used a verb called evaluate. What do you mean by evaluation? Evaluation means you give one benchmark, you compare it with something, and you justify your answer. Evaluation. Somebody has written an examination. Okay, you mark, evaluate it. That means you try to compare with the model answer and say whether this guy has written as per that or not. Now, investment in bond is a financial asset. But should you not write the asset, this thing? Why? Why it is a financial asset? Contractual. Why it is a financial asset? You have to write. See, if you tell contractual obligation to receive, that is a wrong statement. It is the wrong communication because somebody will not understand. See, here your set is right because you have understood and you are intelligent enough to applicable also. But how do you communicate to the evaluator there? Then you have to write contractual right to receive cash. This word should come in your answer. Otherwise, you will get only half mark. Loans and receivables. Same story. Deposits given. Financial asset. Confident. Deposits, when you give deposits, is it a financial asset? What it is for the person who receives it? Liability or equity. Then you say, sir, let us apply the definition and say, no. For this, to tell whether it is equity or liability, we have to go into the substance there. How it is settled, is there an obligation to repay? Okay, otherwise you can always assume trade receivable, same, cash and cash equivalent, bank balance, same, because they may mix and ask you, 7 marks in MTP, don't go by this. Okay, investment in equity shares, why? Why investment in equity shares is a financial asset? You have no? I have given shared the PPT with you. No, my chart is chart I have given. No. What? Why you are telling investment in equity share? Will you say contractual right to receive cash? Gone, half mark gone. Why equity shares is a financial asset for you? Huh? What is the definition? Then you have to say it's an equity investment in other entity. That this is an L1 question, students, because this L1 question makes you to identify and recollect. That's it. It will not go to the next level. You are not expected to know more than this. Sufficient. If you are confident to differentiate which is a financial asset, financial liability, finish. But that will come only for 4 marks. They will not ask you 20 mark question on this. Understood, no? Okay, now perpetual debt instrument, like perpetual bonds, debenture, capital notes, what it is? Perpetual debt instruments. Forget about this because perpetual debt instruments can be any form. No, it can be irredeemable preference shares, it can be debentures. What it is? Financial asset. What? Why you are telling it is a financial asset? Sorry. Okay, so you are going to get interest. You got a right to receive the interest perpetually forever. What about the principal? It is like an equity investment. So you have to measure this instrument at its present value of the future cash flows. That part we will discuss later. But it is a financial asset for you. Physical assets like inventory. Why? Why? Why controlling physical assets are not your financial assets? Will you tell that exact price? That is in your language. That is my language to understand, students. I told you, to make you understand, language is not important. I can tell you anything. But in examination, if you go and write dosa, vada, pav and all, no, they will not give you marks there. You have to write the language of the material there. Because the guy who is sitting there to evaluate is a professional, no. You have to talk to him in a professional language. So what answer you are going to tell? See, you have understood. I know it very clearly. I have understood it. But how you communicate to me that it is not a financial asset? Sorry? Okay, have you come across that? in the definition? Because I have to apply a definition, no there. Does the financial, that I told you cannot express in is my interpretation of the definition. But does the definition says that? I give no copy to you. Huh? Own use, no. Own use is only for a derivative contracts there. Because you don't have contractual right to receive cash. Is there, you hold one inventory. Do you have got a contract to receive the cash? Have you sold this inventory to somebody, and if you have sold this inventory to somebody, then that contract becomes a contractual financial asset to you. But inventory can never become a financial asset for you. Right to use the other assets like lease vehicle, etc. If you have got a right to use. Yes, what you are going to get is only right to use the asset, not the right to get the cash. Followed, no? Intangible assets, patent, trademark. Same story, because you get the right to use somebody's brand name, but you don't get the right to get the cash. Prepaid expenses, because what you are going to get in settlement will be the goods, not the cash. That word should come in your answer keys. Advance given for the goods and services, because goods will be supplied back to you. So since they said the word called evaluate here, when you tell, see there are 3 columns are going to come now. You are going to tell, is it a financial asset or not? Maybe half mark. And why? You have to tell the reason. Why cash is unequal? Because it is specifically covered in the definition. Actually, I missed to ask you, why cash is a financial asset? Equity I asked you, you told me, sir, equity is the investment in some other company. Now, what's the answer institute is expecting from you? Why cash is a financial asset? Tell that, it is specifically told. Understood how to write the answer? And this you have to practice, okay? This I will not practice it by writing here. I expect you to go home, read it. Okay, this is all fine. But certain questions you have to practice and mark it very important. Now, perpetual debt instrument, they provide a contractual right to receive the interest forever. Asset is not going to create a present right to receive the cash. Present right to receive the cash. Right to receive the cash. Followed, no? Right to receive the cash. See the word, keyword. You use your language. Language is not a problem there, but your language should have these keywords. Okay, this question just for your, this thing I am discussing, otherwise this is a very simple question. A Limited makes a sale of goods to the customer with the 45 days credit. Now the customer is entitled to earn a cash discount of 2% per annum if the payment is made before 45 days. And an interest of 10% per annum is charged for payments after 45 days. Normal. That means 45 days is an interest-free credit. If you make payment before, you have to pay the interest, I will give you discount, else whatever, you have to pay me interest. Whether such trade receivable is a financial asset or not. Why? How you see what they said? They said evaluate. But how much? Yes, it may change. But contractually, can you guess how much you will receive? Whatever is sold, no. If he makes prepayment, we will change that because the contract permits both. So how you are going to write the answer here? So you are going to say, yes, it is a financial asset because there is a contractual right. So you say that the financial asset is one which gives you contractual right to receive cash or other financial asset. And you don't repeat the definition because the word they used is an evaluate. Let us see that whether institute is rigorously following that verb. Because if they say analyze whether it is a financial asset or not, then you have to first write the definition and then with the reference to definition you have to put. Otherwise, for not writing definition, you will lose 2 marks. Followed, no? So I will keep in mind when I'm drafting this, you practice this. So in the above case, A has got a contractual right to receive the cash from the books after the expiry of 45 days credit. So before 45 days, I cannot ask you. Or earlier also, I can give you the 2% discount. In whatever case, I know that I'm going to receive cash from him, that to fixed amount of cash. Because if he pays me by the 30th day end, I know how much I'm going to get. If he pay me 50th day end, then also I know today only how much he's going to pay. So I have got a contractual right. Yes, that is why trade receivable meets the definition of a financial asset. Uh, this question of variable testing comes only for equity shares. Fixed for fixed test. It doesn't apply for this cash. That's why your analysis of understanding of this question gives you better understanding of the equation, the definition. Follow, no? That fixed for fixed test and all not applicable. In fact, you get a flavor of 115 here. In 115, once we understand, no, then you realize, oh, there is something called a variable consideration. Because this becomes a variable consideration now, because he may pay you before also, he may pay you after also. That's why you have to use expected value method, probability, in this case. Anyhow, this is not that question, it's a plain question. Beautiful question, students. Most important, and generally, no, all those questions, I will mark it as an important here. See, did I mark any other question important? No, because those questions may come for your examination. See, you have to do something, some analysis like this, students. See, this is mark. This is difficulty. Okay, or I can say probability of occurrence. Or I can say difficulty. So if something is, okay, no, I'll give you this example some other place, because it must should say. See, here you need to figure out certain things which is highly probable for the examination. Okay, now you have to answer me. Okay, this is already sitting in your illustration number 5 in your new syllabus. Plus in MTP also they had asked previously. Okay, this question you don't find this illustration book. Okay, this is the book which I have to give you, yet to give, new print I'll give. This is only theoretically we'll discuss. This is not problem solving questions. Problem solving questions are different set. So I have bifurcated theory questions, practical questions. A Limited is a company, makes a borrowing of 10 lakhs from RBC Bank with the bullet repayment of 10 lakhs and annual interest payment of 12%. What did you understood with this? What do you mean by bullet payment? One time principal at the end of the year, no EMI type of installments. And every year you are going to pay 12%. Now the company defaults in the 5th year. It has been paying interest every year. On day one, is it a financial liability? Yes. Why? Contractual obligation for what? Which cash? How many cashes? How many stream of cash payments are there? How many streams of cash payments are there? 2 streams of payment. One, they have to pay interest every year. Then they have to pay a one-time principal payment at the end of 5th year. Or whatever. How many? Okay, they have not told you the period. They have not told you when the principal will be repaid. So we'll assume say 10 years or 15 years. Because they said the bullet payment. Otherwise, what could have happened? No, if they didn't use the word bullet payment, then this instrument could have been turned into a perpetual instrument. There are 4 types of debt instruments. Which all those? Perpetual instrument. Perpetual means no principal will come to you, forever interest. Or zero coupon bonds, where only one single payment will come at the end of 5th year or whatever it is. You have got a plain vanilla bonds, where you get the principal at the end, every year interest, and 4th is the unconventional bonds, where you get any combination. Now here, they didn't tell me the life, but since they use the word called bullet repayment, I make an assumption that this must be a plain vanilla bond. You have to be good at making assumptions and figuring out what they have given, what they have not given. This is FR. Followed, no? You don't know institute now. I'll show you who is institute with their questions. Now the company default at the end of 5th year. What they defaulted? Interest payment, because anyhow the principal there was no obligation only. And when at the end, and consequently they rescheduled the payment schedule made beginning of the 6th year. That means this must be when? On 31st December. They didn't pay. So on 1st of January they went to the bank and they asked for rescheduling the payments. They said, sir, I'm in a financial difficulty. I cannot pay the money. Can you reschedule my schedule? The company said, okay. The company is required to pay 13 lakhs. They said, the bank said, look, okay, no problem. Do one thing. At the end of 6th year, that is when, say, 2020, on 1st January 2021 you went, At the end of 6th year, that means 31st December 2021, they said, look, you pay me 13 lakh in full and final settlement. Followed? And whatever default and all, no, I'll forget it. You pay me one single payment of 13 lakh rupees. I'll close your loan right now. Going forward, from 1st of January 2022, you don't have any obligation only. You'll be freed. Now, let us come to the question. Does the above instrument meet the definition of a financial liability? What? Evaluate or explain? Explain. They didn't say evaluate. Explanation means, what is explain? You give more information, you evaluate it from a different angles. Like you give one definition, you say that this is so and so, so and so. You try to explain and give more information about it. Now, analyze the differential amount to be exchanged for one-time settlement. Can you tell me, students, what is the differential amount for one-time settlement? Please open up, take out your rough book. I told you yesterday to bring a rough book. Take out your calculator. Students, you please pause the video. Read this question again. If possible, write something. And tell me how you would have done the answer. How you would have written the answer. What is this differential amount they are talking about? Think about it. I'll give you time. Students, please pause the video and analyze this. See, meaning of differential amount means how much they are supposed to pay versus how much they actually paid. That is the differential amount. Because if they are supposed to pay what they have supposed to pay, they have actually paid what they are supposed to pay, there is no question of differential, no. That means you have to compare now two things. One is definitely 13 lakhs. This 13 lakhs has to be compared with the what? That you think and tell me the number. Yes, sure. So now we will discuss about this. But beautiful question. See, what is the differential amount? First thing is, what I paid? 13 lakhs. If I had to pay 1 year back, what is the principal I should pay? 10 lakhs. Did I pay last year interest? Should I not pay? What is my last year interest? 1 lakh 20,000. Did I pay second year interest? No. What is that I should pay? 1 lakh 20. So if I add 10 lakh plus 1 lakh 20 plus 1 lakh 20, how much it comes to? No, but the second year interest will come. Since first year interest I didn't pay, second year interest cannot be 1 lakh 20, no? See, the person who is sitting there, no? See, understand, the very first chapter which you learn is AFM, which is a finance. You should think like a finance guy. Once the financial transaction happens, then the accountant comes there. Now, do you think the bank is a fool that since you didn't pay first year interest, did they ignore that first year interest? No, will they not charge interest on that first year interest also? So how much it comes to? See, it goes like this. I'll show you. It goes like this. So paid is how much? 13 lakhs. Minus what is payable if everything was well, fine. Book value of the loan is 10 lakhs because I never paid this principal. It's always 10 lakhs only. Plus 5th year interest is 1 lakh 20. Plus 6th year interest is not on 10 lakhs. It is 11 lakh 20 into 12%. No. So how much? 1 lakh 1,34,400. So if I add this plus 1 lakh 20 plus 10 lakh, I get 12 lakh 54,400. See, I was supposed to pay 12 lakh 54,400, but what bank told me? Right now pay 13 lakh and get out of. Because there is no prepayment option, my assumption. Otherwise, why I should agree to this? I will say I will not pay. I'll continue. But since there was no prepayment option, the bank said you pay one time 13 lakhs and walk away. I will give you an excuse. So now tell me, this 45,600, am I in a favorable situation or an unfavorable situation? When you are into an unfavorable situation and you got into an obligation to pay cash, what it is? Financial liability. Have you not discussed the definition there? That you get into an obligation to exchange the financial asset. And what you are going to exchange now? Cash. Cash is a financial asset. So to pay this liability, you are going to exchange cash and under an unfavorable situation. That is why the second contract also turns out to be a financial liability. First contract to definition financial liability because you got a principal and interest payment. Per annum. Up to fourth year, 1,20,000 accrued, you paid. But fifth year, 1,20,000 accrued, but you didn't pay. Why? It's a bullet repayment, no, Baba. That's the skill you should learn. Understand here. You don't simply read the question. Spend time to understand the question. It's a bullet repayment. They said very specifically, but they didn't tell you the life there. All smartness you are going to find now in examination questions. Whatever you have to assume, no, you have to write a very clear assumptions. So this is my assumption, but here there is nothing to assume as such. Until it is paid on the last day, life of the life of the. That's what he was paying fourth year. Up to fourth year he has paid 1,20,000, 1,20,000. Fifth year he didn't pay. Now see, now there is no assumption. No, if they would not have told you bullet repayment, then you should have made certain assumption. Assumption is only compounded. That is my assumption here, because I am assuming that 1,20,000 also they have paid me the interest. Okay, now let us see how the examination answer you have to write. So first question, whether it's a financial liability? Yes, he have got into an agreement against the borrowing. He have got a contractual obligation to make interest and principal. Yes, that is why it's a financial liability. You explain it. Is that explanation sufficient? If you feel not sufficient, then you explain more. What is explanation? Explanation means giving a sequence of explanation unless somebody understands it. Now, is this explanation okay? Will somebody able to understand what you are trying to communicate? Enough. Now, second, they asked you analyze the differential amount. Analysis. What is analysis? Breaking into pieces. That's called analysis. So analysis means first you have to prepare one working note. What is the differential amount they are talking? Have they told you in the question? No. So first you will calculate one working note, differential amount. 13 lakh is the payment and 10 lakh into 1.12 into 1.5 amount, this. So then say the differential amount of 1.2 is unfavorable because of the contract number 2 now. Because contract number 2 entered on first. Now hence the reschedule arrangement meets the definition of financial liability. When you will pass this entry, accounting entry? On when this became a financial liability to you? It became financial liability on 1st of January, 6th year beginning. Because today you entered into a contract, no. This is payable at the end, 13th. But this second contract became right now. So what accounting entry you need to pass for this 45,600? Should you pass any accounting entry? What? When? I expect this question should come from you. Don't simply look at the question here, a classification, this application or definition. That is, then you are thinking from an examination point of view. When I should pass an accounting entry? What accounting entry I should pass? Yes, what accounting entry I should pass? Simple, Baba. When you are into unfavorable situation, what you should do? Debit P&L account, credit loan account. So your accounting entry is unfavorable loss because of one-time settlement to loan. When you will pass this entry? The day you enter into the second contract. When? 1st of January, not on 31st March, because it will move to the next year otherwise. On 1st of January, you are going to pass this entry, and then on the day of settlement, see what happens. It happens like this. You pass this expense account debit to loan. How much? 45,600. Then you pass loan account debit to bank along with the interest. That's whatever differential interest is there, no? Because you are going to find out the present value, because this is 45,600 when you are paying at the end of the year, no? You find out the present value of this and you will account it. That we will go into later. You will not pass entry for 45,600 because this is a financial liability. Financial liability has to be passed to today at the present value of what you are going to pay. Anyhow, that is not required, but have you understood the concept? Sorry? Hmm. No, because they said bullet repayment. No, no relevance. You need not bother about it. That's what. No, we can assume 20 years. Now there was a 20-year contract where both the parties could not have come out, and now one-time settlement is happening. And when these all discussions were happening, you are not the part of it. You are an accountant there. And then they gave you. Yes, Prithvi? Clear, no? Perpetual bond. It could have been. In that case, principal repayment, this payment doesn't come, no? That is the equity portion. It is not a, but we can treat it like that. But anyhow, you need not bother about that, because they said, yeah, we can discuss that. It will be we call it it's a split accounting. It's a compound instrument, because principal portion becomes the equity, and the interest what you pay now every year, that becomes your financial liability. Anyhow, we'll come to that more. You will understand more. But did you get a flavor of what type of questions are going to come for exam? Yes. Next, Silver Limited issued a irredeemable preference shares with the face value of 10 rupees each at a premium of 90 rupees. What accounting entry they must have passed? Sorry? You can write, you can take the book and start scribbling. Bank account debit 100, preference capital 10, premium, securities premium, preference premium, whatever, 90. Now, these shares carry a dividend of 8% per annum. However, dividends are paid only when Silver declares the dividend on the equity shares. Now, analyze the nature of this instrument. What type of instrument it is? What is the nature of this instrument? Okay, you pass the entry. Does it change any entry? That I already shown you. Initial recognition entry doesn't make any difference at all. Whoever on the earth, they are going to pass the same entry. But my only one question to you is, where you are going to show this preference capital? Is there any components there? Is it a compound instrument? Generally, how many streams of payments are there? Principal and interest. Are you going to repay the principal? No. So principal is by default, it's an equity. Are you going to pay the interest? Interest or dividend? Do you have got a contractual obligation to pay the dividend? Why? Because you will pay the dividend only when they declare the dividend on equity shares. Now we will look into, do I have got an obligation to declare dividend on equity shares? Is dividend on equity shares is mandatory? No, that is, nobody can force me, no. So I can avoid paying dividend on the equity shares, and I can avoid the payment of interest. So that means this entire instrument is going to become equity. Otherwise, if this was a cumulative dividend was there, it is an irredeemable cumulative preference shares, then the principal portion would have become the equity, and the interest portion would have become a financial liability. So this 10 lakh, no, the 10 rupees, I have to break into two pieces now. There is one debt portion also. That we will see, compound instrument, split account. At this point of time, they don't expect you to do all these things. They want you to just analyze the instrument. So you say that the instrument meets the definition of equity. Why? You don't have a contractual obligation to pay cash, irredeemable. And you are going to settle in the own equity shares. It is a non-derivative, settled only by fixed number of shares. Derivative contract will be settled by the fixed shares or variable shares. The two main characteristics of preference shares, they carry a dividend. First, you have written the definition of equity. They say that an instrument will be equity if it meets any one of these. So now, when you talk about this given case, this preference shares has got two characteristics. What is that? It has got a dividend, which is payable only if the company declares the dividend. It has got a principal, which is irredeemable. Since it is not redeemable except on a liquidation, so you don't have any contractual obligation, and it is a discretionary dividend. That's why both the component forms part of the equity. So when you, by looking at it later, see, now still there may be an element of doubt, students, I'm telling you. But as we solve the problem, no, you are going to get that clarity. Followed? Then when you revise it second time with my book, no, you get that understanding. But these questions, what I feel, are highly probable in the exam. When it comes, you have to write this language only. Don't write any other thing. Learn how to write it. Target Limited took a borrowing from Z Limited for 10 lakh rupees. Z enters into an arrangement with the Target Limited for settlement of the loan against the issue of certain number of equity shares of Target Limited, whose value equals rupees 10 lakhs. So when you have taken a loan, what accounting entry you pass? Bank to loan. Now where do I show this loan? Is it a financial liability for me? Okay. Why do I have got a contractual obligation to pay cash? Where? Because I am going to settle it by issuing my own number of shares. No. Then you will say, sir, since this is part of the second definition. Now. Settlement is going to happen by cash. Now, for this purpose, how many shares I am going to issue? Variable. Why? Because they said they will issue shares worth rupees 10 lakh. That depends upon my market price on that day, which can be anything. For this purpose, the fair value, total number of equity shares is determined based on the market price at the future date on the settlement date. So, evaluate the definition of the financial instrument. What do you say? Why? But how will you say fixed to fixed test is not matching? You can tell in the layman language. Fixed to fixed makes us understand it better. But I wish you please write the definition. Okay, so let us see the answer. So the answer will be in the above scenario, because they said evaluate. Again, the definition they didn't go for. If they say analyze, you start with the definition. So this you should learn. When should I write the definition? Not to take risk, you write always. In the above case, they have got an obligation to issue variable share. This will fetch you 1 mark to tell you variable number of shares. So you have used your shares as a currency for the settlement by issuing variable shares. That's why it is a financial liability. Okay. Now you have to tell, see, first we started whether it is a financial asset or liability. Sorry, financial instrument or not. Then second we discussed whether it is a financial asset or not. But if this question comes in the exam, no, then you have to tell either financial asset or liability. What is the verb they used? State. So stating, what do you mean by state? State means express something in the form of one sentence. Enough. Only one sentence you have to state. Now bank advances a 5-year loan. The bank also provides with the overdraft facility. What it is? Sorry? Okay, financial liability for whom? For the entity. How many financial liabilities? One financial liability or two financial liability? There are two. Two different contracts, no? Under one contract, have you given 2 loans there? You have given a loan and you have given an overdraft facility also. Okay. Now, when in overdraft, what happens? Okay, so you have to withdraw that money. Then your obligation is going to come to repay that. So you say there are 2 financial liabilities. Your assumption is you are going to evaluate from the entity's perspective. Liability for an entity. They didn't ask you from both the parties. Now, entity A owns preference shares of entity B. Preference shares entitle A to dividend but not any voting rights. For whom? Entity? Who is the financial asset? For entity A, it's a financial asset. But since they said evaluate whether financial asset or liability for entity, should you consider entity B also now? Not for the bank, first question. This is what institute is doing. Understand the question. If you miss and write only for entity A, no, you will get 1 mark out instead of 2 marks. So for A, what it is? Why? To receive the contractual cash of only dividend, not the principal, because principal is very silent here. For entity B, it is a financial liability. Entity has got a present obligation for income tax due for the prior year. Is neither a financial asset nor a financial liability. Lawsuit brought against the company and you have to pay some money. Okay, first why it is not a financial asset or liability? There is no contract. That is the key word for you. Here, lawsuit, and somebody brought a lawsuit and you have to pay money now. No, because there is no contract. No. Are you paying the liability under a contract? No. So that's why contamination was there or not there, whatever it is not a financial liability for you. So how you are going to write the answer? The entity has got two financial liability: obligation to pay 5-year loan, obligation to pay overdraft. To the extent it has borrowed, both the loan and their result a contractual obligation to pay cash. That's why it's a financial liability. Understood the answer pattern? Now entity B, it is a financial liability. Entity A is a financial asset. Now for entity B, whether it is a financial liability or equity, that depends upon the terms and conditions of the question. Whether it is a redeemable or irredeemable. Have they told you preference shares are redeemable or irredeemable? No. Then you made an assumption that it is irredeemable preference shares. So you have to write as per the terms and condition. Income tax liability is not a contract, so it is not a financial liability. Lawsuit may result in payment of cash, but it is not, there is no contract. That's why you need to make a provision as per Ind AS 37. Yes, so many questions can be possible. 7 questions. See, there are more questions which I have given you for your self-study. Read it for your understanding. But I feel that these 7 questions, they may ask you for your exam. Yes, students. So now onwards, we will discuss about the financial asset, which is the, now onwards, all problems. No theory now. We are almost done with the theory. Again, theory is going to come. We will see it later. Because now if I discuss theory, it's more confusing. Now what we are going to discuss? We are going to discuss about the measurement and recognition, transaction cost accounting, subsequent measurement, and regular way purchase and sale. Only 4 things we are going to discuss. How an initial recognition of financial asset should happen? Entity shall recognize the financial asset. What is the financial asset? Contractual right to receive the cash. Only and only when the entity becomes a party to the contract. The day you sign, you get a right to receive. Then only you can recognize or pass entries in the books of account. Till you sign the contract, you should not pass the entries. So what is your accounting entry? On the day you sign the contract, what accounting entry you are going to pass for a financial asset? Financial asset account debit. Financial account debit is nothing but recognition. That's called recognition. That's called initial recognition. Now question comes, what is your initial measurement when you pass an accounting entry, financial asset account debit? What is that amount you are going to write? Now you have to look at the standard. What my standard says? Because standard will talk different thing. If you talk about inventory, they say inventory should be valued at cost. PP should be valued at cost. A financial instrument should be initially measured at a fair value. All the financial assets should be initially measured at fair value. Now, what is fair value? Generally, the transaction price itself is the fair value. Correct, no? What is fair value? Acceptable. So, if at all in our game, you have to give some portion to me, right? If you offer 50-50, is it fair? So what is the transaction price? 50-50 is the transaction price. Why? Because it is acceptable. Because accounts makes one fundamental assumption that when certain transaction happens, it happens between the knowledgeable parties. And the transaction happens at a market terms. So if the transaction is going to happen at a market term, the transaction price is going to be at the fair value. So if it is at a market term, I told you, it doesn't make any difference to you. Then you say, sir, why we are learning this? It's the same, your first PUC accounting. Now comes instrument at off market term. I showed you on face, no? Gongaya. Now what the standard says, look, sometimes certain instruments may be exchanged in different terms other than the market term. In such case, the entity shall measure the fair value. Now how to measure a fair value of a financial asset? Simple, present value of the future cash flows. Because financial asset is a contract, no. It's a definite cash you are going to get at a different point of time. Find out the present value. In AFM, what we learn? Discounting. Because it's like a debt instrument, no. Now, if the fair value is based on the L1 input, now what is this L1, L2, L3 input? Index 113 is going to discuss. L1 means observable. L2 and L3 means not observable. Like if I ask you, what is the fair value of Reliance share price? How did you know? Where to refer this? And then you say, sir, open one yesterday's newspaper or just log in into nsc.com. Whatever price is told, it is the fair price. That's called L1, observable. Now, what is the share price of Taxman Private Limited? Then you say, sir, Taxman Private Limited and Suchitra Publication Private Limited are peer. If you want to find out the tax price, the share price of Taxman Private Limited, Suchitra Publication is already listed. Take the PE ratio of Suchitra Publication. Using that, take their EPS and find out the price. Now, is it observable or unobservable? Observable. No, PE ratio is observable. But you made certain adjustment to it. That's why it's L2. Now you take, there is no peers only. Then you do one thing, sir, take their budgets from them. Next 5 years, how much cash flows they are going to earn. Now, that 5-year, 10-year cash flow projection they are given. In 10 years, I will also give, if you somebody ask me, no, in 10 years down the line, 1 year per month, I will make 10 crore rupees. What is there to give the projection? But is it observable or unobservable? Unobservable, that is called L3. Understood the difference? L1 input, L3 input. Because whenever I want to calculate a fair value, I need inputs. Now that inputs are observable, it's called L1. It's observable but require adjustment, it's called L2. Unobservable, it's called L3. So if the fair value is based on the observable market, the difference between the fair value of that instrument and the transaction price at what we entered into, charge it immediately to the P&L account. In all other cases, that means other than L1 input, you have to capitalize or amortize or charge to P&L account over a period of time. So initial instrument shall be always measured if it is at a market term. Headache is not there, fair value is equal to transaction price. If it is at off market term, you have to calculate. And if it is based on the L1 input, see, off market means definitely there is a difference going to come, no? Definitely there will be a difference going to come because you are going to use a different discount rate there. If it is L1, then charge to P&L account. If it is L2, then you can call account, you can capitalize it and charge to P&L account over a period. Are you clear about this? Okay, we'll apply this principle there while solving the problem. How to do it, what to do. This is in theory. Anybody in the world is going to ask you, you have to tell this theory from now onwards. Questions will say analyze the instrument. Then you have to write this theory. They say analyze the measurement principles. Then you have to write this theory. Initially, the instrument will be measured at a fair value. Sometimes there can be off-market instrument. We have to calculate it. So this theory has to be written. Now, how the transaction cost accounting is going to happen? See, transaction cost are never the fair part of the fair value. Because whenever you calculate the fair value, transaction cost doesn't come into picture because transaction costs are not going to enhance the fair value. It's always there. So transaction cost like fees, commission, agents, brokers, etc. How do you account this? That depends upon the classification of the financial assets. Something new came. You'll ask me, sir, what is this classification? Wait, we'll discuss that later. That is the crux of this financial asset. It says that if the financial asset is classified as FVTPL, that means classification. There are 3 classifications: amortized cost, fair value through P&L, fair value through OCI. That's it. There is no 4th classification. Now, why there are 3 classifications only? That also I'll tell you. Now, if the asset you are going to classify at fair value through P&L, charge the difference to P&L account. No, not difference, sorry. Transaction cost to P&L account. If it is classified at amortized cost or OCI, adjust it to the book value. Now, say for example, we'll take one example and we'll do the entries. Now, you invested in one shares of the company. Say, what is the fair value of that? 100 rupees. Did you buy at a fair value only? Yes, you purchased at a share. You invested in the debenture. You purchased at 100 rupees. The transaction cost is 5 rupees. Now, can you tell me what accounting entry should I pass on initial recognition? When should I recognize? When I enter into contract to purchase. What accounting entry I should pass on purchasing the debenture? Debenture account debit is a financial asset, no? Debenture is a financial asset for you. Why? Contractual right to receive cash. Debit 100 to bank. Whom you paid this 100? You paid to MRPL. They issued debentures, no? Then there is a transaction cost. Whom this transaction cost is paid? To some broker. What accounting entry you pass for the transaction cost? Transaction cost account debit to bank. In fact, you could have passed one consolidated entry. Now I will ask you one more question. What you will do with this transaction? What is the nature of this transaction cost? What is the nature of account? How many accounts are there? Personal, real, nominal. Transaction cost is what? Nominal. Can you keep it in the balance sheet? No. So what you should do? Wait. We have to close this. First of all, this close. How we are going to close this transaction cost? That means there should be two transaction cost, 5. So that transaction cost get. Now only question comes, which account should I debit? Now comes the rules. They say that if this debenture, whatever you see here, no, if this debenture could have got into 3 classifications, it's called a subsequent, it's called a classification. It could have been amortized cost, it could have been FVOCI, FVTPL. If this debenture value itself will go to FVTPL, the transaction cost also you charge to P&L account. That means your opening entry has got no hit with the transaction cost. But if your accounting is going to happen amortized cost or your FVOCI, then what you should debit? What should debit? You should debit loan or debenture account. So, did you add it to the debenture or did you deduct with the debenture? Why did you add it? Because you credited transaction cost account. That's why. Understand this logic. If the financial asset is there, because liability it becomes ulta, and you incur some transaction cost. If that financial asset is classified as FVTPL, you have to charge it to the P&L account. If that asset is classified at FVOC or amortized cost, you have to add to the value of financial asset. Have you understood this logic? Why I am adding it? Simple, students. See, in exam you may get confused. Should I add it or deduct it? Think journal entry. I told you, no? Confusion means lamp. Transaction cost comes to me. What accounting entry I pass? Transaction cost to bank. What is this? Financial asset. Asset is the debit balance. Transaction cost is already a debit balance. So I have to close that. You credit it. So what should I do? Add to the financial asset. Understood the logic? Sorry? That's called a classification. I will tell you what is the reason for classification. Because you must be holding the debenture only with the intention to sell. Intention to sell, not to intention to hold. Very interesting. Okay, this transaction cost accounting is clear. So this is my explanation. When we pay the transaction cost, our accounting entry is transaction cost to bank. And since financial asset is as amortized, we are going to prepare an amortization schedule. That's why we have to add to the financial asset, because our accounting entry is financial asset to transaction cost. So are you clear about the logic of adding transaction cost? If somebody asks you, you should be able to tell. In examination, you get confused. Think about the journal entry. Because see, in accounts, any calculation you do, whenever you do plus and minus, no, that plus and minus is represented by one journal entry. You add because there is one credit or debit. You deduct because there is one credit or debit. Now, how do you subsequently measure it? Today, You passed one accounting entry, debenture account debit to bank. At the end of the year, did we start with one recycling? You told me, sir, at the end of the year it is 1,05,000. So at the end of the year, should I keep it at 1 lakh only? Or should I make it 1,05,000? Is there any rule? Yes, that's what my standard is going to tell. Every single standard, PPE also, everything is going to talk about initial recognition, initial measurement, subsequent measurement, subsequent recognition they will not talk. So any transaction happens, initially you recognize it, initially you measure it. And if it is a balance sheet item, you will subsequently measure it. If it is gone out of the balance sheet, there is no question of subsequent measurement. Clear? Now, how do you subsequently measure a financial asset? That means at the end of the year, if that asset is still sitting in your balance sheet, at what value you will show? Initially, you will recognize at a fair value. What is fair? Acceptable. Present value of the future cash flows. But if that asset is still there with you at the end of the year, you are not yet sold it, at what value you are going to recognize it? The standard says, look, that depends upon classification. Now tell me, students, the measurement is going to depend because there are only 3 classifications. In fact, there are only 2 classifications called amortized cost, fair value. Now, why there are only 2 classifications? Why there is no third classification? And under fair value, there is 2 sub-classification. Just because OCI statement came under Ind AS. If it was not there, like if you are talking about accounting standard, there would have been only 2 classifications called FETPL and amortized cost. Now, first of all, why on earth there are only 2 classifications called amortized cost and fair value? You got my question? That you should ask me, no? That you should understand first. Why on earth there are only 2 classifications? Since if you talk about accounting standard, there is no question of OCI only. That's why they never speak about 2 sub-classifications. There are only 2 classifications. Why? Where is the question of expenditure here? Okay. For this, you need to understand what is an asset. What is an asset? When? Future. We are also asset, right? Why? Because we are going to earn cash in the future, no? So, our valuation or assets valuation depends upon how much it's going to give you cash in the future. Now, there are only 2 ways you can get cash from the asset. What are those ways? Either you retain that asset, it will earn you salary, or outright you sell that asset. One lump sum payment you are going to get. You go to the bank, you want to keep an FD. There are only 2 ways of FD. One FD is you keep an FD, every month or every year they will pay you the interest. How much they will refund you at the end of the year, 5th year? Principal only. They will not give you any capital appreciation. Alternatively, don't take that intermediate cash. How much they will give you at the end of 5th year? Double the money. Followed, no? So any asset in the world, there are only 2 ways you can get the cash. By holding it or by selling it. Sell is nothing but a fair value. You sell it. You hold it. You collect the contractual cash flows. That's why we have got only 2 classifications. Followed, no? Called amortized cost and fair value. Under fair value, since OCI is the new statement, there's 2 more classifications. Are you fundamentally clear? No questions? On day 1, you have to classify it. You have to be clear. That's why you purchase it. No. On day 1, did you not know what you are going to do? When you go to the bank, you want to keep an FD. On day 1, will they ask you, do you want a cumulative interest or do you want a monthly interest? When you know this? You will come to know only at the end of the year, or will you know on day 1 when you sign that FD form? Day 1, no. So classification doesn't change the accounting entry on day 1. On accounting entry, day 1 same. But subsequently, what value I'm going to get, no? That depends upon on your day 1 classification. You can't change it later. After first year interest is paid, sir, don't do this. Then it is a new contract only. You have to close the previous contract, you enter into a new contract. I hope it's clear. Now, what is amortize? Reducing value of intangible asset over time. That means actually financial asset is an intangible asset. No. Can you keep this forever? No, you have to kill it. Amortization means killing an intangible asset. Depreciation means killing a tangible asset. Both are unobservable. Because if you observe it, like depreciation is what? Reduction in the value of an asset. Like building value is diminishing. One day one earthquake happened and one of the portion fell down. What you do? That day only, since it is observable, you charge it to the P&L. Correct, no? That's because you got an L1 input. You see that sudden diminution has happened in the value of the investment. You call it impairment also. Now, Ind AS 109 does not permit cost model. That means you can't say, sir, I will keep my financial asset at cost only. Last year I purchased at 100. I will go on maintaining it 100. No. Either you have to amortize it or you have to keep it at a fair value. There's one more cost option. It is under 27. If you have invested the financial assets of a subsidiary, that means if you have acquired the equity shares of the subsidiary, then I will give you an option to keep it at cost. Right now, we will not mix that. Let us focus here. So now we will come to the crux of your classification, test of classification. Okay, you are focused, not tired. We will discuss this because I want your full attention here and understand it, because if you are not understood, no, later I am going to repeat 100 times here. Every question I am going to ask this. Then if you are not understood, there is no point there. How to classify? There are two tests of classification. That means on the day one, when you sign the contract, you have to apply a business model test and SPPI test or CCFC test. Solely payment of interest and principal versus contractual cash flow test. Now, what is your business model? There can be three business models. You have purchased this asset to hold, to collect HOC. You have purchased this asset to sell, hold to sell. That means anytime you are going to sell it. Or you have purchased this asset with the hold to collect the contractual cash flow. If you get good value, you will sell it. Simple. Your parents will purchase one land. On the day one, do they know the intention of purchasing the land? If you go and ask them, why did you purchase this? You say, Baba, I am going to hold it till your education. So whatever contractual cash flows are going to come from that land, no, your intention is not to sell it. So when you don't have any intention to sell you, am I interested in the fair value? Is your parents go from time to time and check what is the market price of my land? They're never interested. That's why fair value concept doesn't come when your intention is to hold any asset till next 10 years. You need not go and check in the market price. Simply amortize it. No, you say, why you invested? Because you got extra cash. You invested just to get a capital appreciation. Will your parents every day go and check in the market how much is? That is hold to sell means FVTPL. That means your intention is always to sell only. You never acquired with the intention to hold. But your parents acquired one piece of land with the intention to hold it until they get a good price. Then the third classification. Are you clear? Okay, what is this business model test? And this has become entity specific. It can change from, it's the same debenture. Debentures issued by MRPL. You acquired it, I acquired it. Your intention may be to hold till collect. It's the same debenture. My intention is to hold to sell. That's why the business model test is called entity specific test. Are you clear? And second is called instrument specific test. This refers to how entity is going to manage the financial assets to generate the cash flow, with what intention they acquired, okay, whether they hold this to earn the cash flow by using it or by earn it by selling it. Okay, there can be three: hold to collect, hold to sell and collect. I told you. Now, what is the second test? It's called solely payment of principal and interest, and it's called instrument specific test. You have invested in a debenture. What the debenture is going to give you? They will give you principal plus interest. Will they give you anything else? Like suppose you have invested in equity shares. Is equity shares financial asset? Yes. What they are going to give you? Then you should ask me, sir, will they give you a principal? May or may not. Will they give you interest? Sir, they are giving me dividend. So what is the definition of interest? Interest is something reflect a return that's consistent with the basic lending arrangement. That means that when you have given a principal loan to someone, they should give you time value of money. It should cover credit risk. It should cover basic lending risk like liquidity, cost and the profit margin. That means you have, say, bank is charging you 12%. 12% should include only these 5 elements. Now I will give you a loan. Okay, say for example, I give you a loan. I will say, give me you have to pay me interest at the rate of 12% and principal 100 rupees back. Can I say my instrument is passing SPPI? You say yes, this is a normal lending. In the second scenario, I will tell you, you have to pay me interest principal 100%, but the interest you have to pay me variable, LIBOR plus 1%. Can I say it's a normal lending? Yeah. Have you not come across variable housing loan? Normal lending. But if I tell you, see, I will give you a loan today. How much you need to repay me is 3 times your share price. Is it a normal loan transaction? No, it's an off-market transaction. That's why I say that this instrument fails SPPI. Why? Because what they give me back may be 0 or maybe 10 crore. What they pay me is not principal plus interest. Why? Because it is 3 times, there is a leverage there. That's why this is called a SPPI test. Are you clear? See, one is entity specific test we have to apply, another is the instrument specific test we have to apply. Okay, now let's come to the classification. When you should classify something as an amortized cost? When 2 conditions are fulfilled. That means when you acquire any financial asset whose business model test is to collect HOC plus SPPI test, it passes, yes, classify them at amortized cost. This is the rule. You can't shift it. No company in the world can deviate from this rule. Have you understood? Yes. Are you clear, Vishnu Priya? Trying to figure it out? Are you clear? See, students, yes, see, I understand. It may be too much for you for today. We'll maybe after this classification, we'll wind up. I wish you go back. Prepare what we discussed, because without this discussion, I can't touch the questions. And just now I showed you one theoretical question also, how definition will be applied, correct? You can see the one element of complexity there. It's not so easy, no. So if I have to solve the problem, you have to be very clear about what the theory speaks. And have I given you every theory of the study material? Please open the study material and you see. You understand how much theory is there. I have given you only that theory which is helping you to solve the problems. So every single word what I'm writing here, it is my hard work. So I expect you understand it. Followed, no? Yes. Now, are you clear why we classify any asset as amortized cost? Simple. Any financial asset which you acquire with the intention to hold, to collect till its lifetime, is HOC. Plus, what they give you back is only principal and interest, not like equity shares. Equity shares will not give you principal at face value and your dividend. They may give you anything, no? So, if 2 test passes, you amortize cost. When you will classify something as an FVOCI, the business says that you, again, 2 conditions. First of all, whenever you acquire any asset, your intention or business model is also called intention. Your intention was to hold, to collect or sell. That's why I prepare amortized cost also, fair value also. That's why we call it FVOCI. So your intention is to get the cash flow till it pays. If you get a good price, you sell it. What about the test? It passes SPPI test. That means what it is going to give me is the principal plus interest. Now, they said that, look, if you have made certain long-term investments, Say, for example, an entity may make irrevocable election option to recognition of particular investments in equity instruments, which is not held for trading, to carry at FVOCI, which otherwise would have joined FVTPL, because FVTPL is the balancing figure. Some asset which is not amortized cost, which is not FVOCI, is balancing figure equity. Now, when it comes to equity, tell me whether equity will pass SPPI? No. So, the moment one of the condition is not fulfilled, you say FATPL. See, to become amortized cost, two conditions should fulfill. One, HOC plus SPPI. To be FVOCI, two conditions should fulfill. HOC bar S plus SPPI. If any one condition doesn't fulfill, FATPL. So, equity is by default FVCPL, but if your intention to hold that equity for a long term, then I will give you an option. Instead of FATPL, take it to FVOCI. That's why in your OCI, did you see that equity FVOCI? Those are called the designated. That means by default, they would have landed up in the P&L account. Fair value changes would have landed. But you said, no, Baba. My intention to hold it for a long term is my subsidiary. Or it is a strategic investment. I don't want to show the effect in the P&L account. Then do one thing, no. Take the effect to the balance sheet, OCI. Keep it there till the time you want. And the day you realize what to do, recycle or not to recycle? Not to recycle. Why? Or at that time recycling. But why equity I'm not recycling? Because your intention, see, by default it would have landed up in the P&L account, but you didn't want the effect in P&L, no. You took it to the balance sheet. That's why when you realize why you want to take it to the P&L, if your intention to take to the P&L, day one only you take, no. Why you took an election? It is an option, Baba. I hope you are getting connected. It was an option you elected, right? Now, assets at a FVTPL, which is not classified as amortized cost or FVOCI, it is a balancing figure. However, there is one more exception to this rule also, because you have to define it for universal, no? They say that, look, however, on initial recognition, again, you can designate, you have got an option, but it is irrevocable. Once you take that option, don't shift it tomorrow after 1 year, so I want to shift it. No. These are option, one-time options for you. You can treat something as an FVTPL if it eliminates accounting mismatch. Now, what is this accounting mismatch? It is, say, for example, it goes like this. Today, you have issued one debt, or you have invested in one debt. Is it a financial asset? Financial asset. Now, is this debt is going to be, did the SPPI test it passed? Did this debt pass SPPI? Yeah, because what this debt instrument is going to give you, it will give you principal plus interest. Will that give anything? And it is a fixed debt, okay? Say 12% is going to give you fixed monthly. But you don't want fixed. You want variable. What to do? But already you have entered into one fixed debt. What can you do? Question is clear? Say MRPL issued one debenture. It is a fixed debenture. That means every year they will pay you 12% on your investment. How much you invested? 100 rupees you invested. So every year they will pay you 12 rupees. And at the end of 5th year or 10th year, they will pay you 100 back. This is a financial asset for you, financial liability for them. Understood? Now, does it pass SPPI test? Yes. Why? Because what MRPL will pay you is only principal plus interest. What is your intention? To hold till collect, not to sell. But what you wanted, no, not a fixed, you wanted a variable. Can you go to MRPL, can say after, sir, I don't want fixed. Can you change for me only interest variable? And MRPL say, get lost. If first of all, you should have thought this when you invested. And for one investor, I cannot change. So what to do now? Can you give me idea? Sorry? Loudly. No, I don't want to sell the debenture. I want to hold the debenture. But I don't want fixed interest. I want a variable interest. Can you give me any idea? Sorry? Yeah, loudly, loudly. Anybody can tell? Compounding, no. I want a variable. Variable means no, Libor plus whatever. Simple, no, Baba. Did I not teach you derivative sometime back? Go for a swap, no. You go for, it is called a plain vanilla swap. So in derivative chapter of AFM, you are going to learn this. What is this plain vanilla swap? It says that I will pay you fixed to 12%. You pay me variable Libor plus 1%. Simple. I converted. Now, I enter into two contracts. This is a derivative contract. Now, will the derivative pass SPPI test? No. So, derivative will land up in FVTPL. This original instrument will land in amortized cost. Arey Baba, both are same, no. You can't look this instrument in isolation, right? Both the instruments, you have to look it together because you have performed one. This is one swap happening with regard to this. So there is one accounting mismatch happening. One leg you will transfer to amortized cost, another leg you will transfer to FVTPL. And this is called a accounting mismatch. So you have got an option one time, whatever goes into amortized cost, no, change it into FVTPL. You can't change FVTPL into amortized cost. That is not possible. There is no option. Do I have any option here? If I go back to the definition, is there any option given here? In amortized section, is there any option given to me? Sure. Is there any option given to me under the heading called amortization? No. Is there any option given to me under the heading called OCI? Yes. An equity instrument, I have given an option which would have been landed at P&L, I can make it OCI. Is there any option given in FVTPL? Yes. Whatever would have landed anywhere, you can bring it into FVTPL to meet the accounting mismatch. Are you clear about this classification test? Which part is not clear? Accounting mismatch is, see, you enter into one contract is there. By default, this is the financial asset. This would have been landed in amortized cost. Do you have any doubt? No. But to make the instruments character change, now what happened? No, if you combine both instruments together, is this instrument got converted from fixed to variable? If you look only one instrument in isolation, this is a fixed debt instrument. This is a fixed instrument. But if you take both the instruments together, because this is based on a notional income, notional amount, you converted a fixed debt into variable debt. Should you not tell the investors what you did? But if you want to tell them, problem is this will go into P&L. This will go become an amortized cost. Again, I understand you may not have grasped fully because amortized cost and all you are not understood now. I have not even come to that. We will discuss that. So logic here is whenever you enter into derivative contracts for the purpose of hedge accounting, you can, something which would have gone into amortized cost, now you can reclassify into FVTPL. Okay, let me show you here rules. And this is my favorite. I'm going to ask you this thing only going forward. How many types of financial assets are there? 3 types. How many types of securities are there? 3 types. Bonds or debt, equity, derivative. Is there any fourth? Is there any fourth? No. Let us apply this one by one. These 2 tests. Which 2 tests I need to apply for classification? BM test, SPPI test. Now you have invested in one derivative instrument. First thing, let us talk about this SPPI. Does a derivative instrument meet SPPI definition? No. Why? Because what a derivative contract is going to give you, it is not principal plus interest. What it is going to give you is not principal plus interest. Follow, no? That's why a derivative contract will always fail your test of SPPI. By default, it is always designated at FVTPL. That means the change in the value between opening balance sheet and the closing balance sheet Whatever changes comes, no, take it to P&L account. Are you clear about this? Is there an option? No option. Derivative, why you hold? Always you hold for trading only, no? For speculation only you hold, no? So there is no option whenever derivatives are there. What all derivative? Forward, future, swap, option. Always the difference between the opening and the closing balance, or two measurements, date, initial recognition and subsequent measurement, you have to take to P&L account. Let us talk about the debt portion, equity. Will equity pass the instrument test, SPPI test? No, because it will fail SPPI test, because what they will return, today how much you give? 10 rupees face value you give. What they are going to give you back? Maybe 0 or maybe 10 crore at the time of their liquidation. That's why equity instrument will always fail. So the default place for an equity instrument is FVTPL. Default place. Whenever you go and buy any equity shares of other company, its default classification is FVTPL. Now question comes, okay, why did you purchase? Are you planning it to trading? If your answer is yes, there is no option. It will land up in FVTPL. Now question comes, no sir, I am holding it for strategic reasons. So I am not interested in its day-to-day price changes. Then, will you opt for OCI? This is an option, right? No, I don't want to opt. That's okay, no, it is entity's decision. Take to FVTPL. But if you opt, then the difference in the fair values, you remember the recycling example I gave you? Debt means you will take to P&L. Other, if it is equity, you have to take the OCI reserve. You will create FVOCI. Is it recycled or not recycled? Is it recycling or not recycling? It is not subject to recycle. That means the day you realize the cash, don't take to P&L account. What is the logic? Arre Baba, on day one only you could have taken to P&L account. You only opted, I don't want. I want to create a reserve. Now when you're realizing why you're transferring it to P&L account, Baba, see the intention there. See the account, how powerful and how strong. They will not simply permit you. You can't do. If you do it, auditor is going to qualify the report. You can't fool around now, people, like what you have been doing under accounting standard era. Are you clear about this, FVOCI? Okay. Now let us talk about the third classification. Debt. Now debt comes, see, debt will generally pass SPPI test. Okay. If there is any instrument which fails FVPI test, where debt will land? It will land up in FVTPL. Chalo, if it passes FPPI test, then question comes, what is your intention? Because for your equity instrument and for your derivative instrument, there is no question of intention. Why? SPPI test fails, no. So you say, sir, I want to hold it to collect the money, dividend, I want to hold it to sell. Nobody is going to ask you this because your SPPI test has failed. Now, if you have purchased a debt instrument and your intention is to hold to collect, where you have to take it? Amortized cost. But wait, can you opt for FVTPL? Yes. Accounting mismatch. There are only two options here. Huh? One is to equity instruments only, not for debt instrument, to take to FVOCI. Second is something which you have been landed up in OCI or FVOCI, you can transfer it to FVTPL for accounting mismatch. This option is for accounting mismatch and this option is for equity shares. That's it. Have you opted? No. Then amortized cost. That means you have to prepare an amortization schedule. Yes, I have not out. Okay. Yes, FVTPL. What is your intention? Hold to collect a bar sale. Oh, you pass test, SPPI test or CCFC test, and your intention is to hold to collect. Have you opted for FVTPL mismatch, accounting mismatch? No. Then take FVOCI. Now, is this FVOCI is recycle or no recycle? This is recycle. That means the day you realize money, you will transfer it to P&L account. Why? Because your objective was to hold, to collect also, sell also. That's why it's subject. That year it will go to P&L and from there it will come to retained earnings. Equity, no, it will go from retained earnings to balance sheet to balance sheet. So if your objective was to hold only to sell, it will land up in FPT. Yeah, I understand, friends. It's a heavy. But tell me when you will study this. After you are already loaded or initially? No. Do you have any choice not to study this? No choice. No choice. If examination, okay, you can gamble. Interview, what you will do? This is the question they are going to ask you. Because this is the crux of this chapter, friends. You have to learn it. You have to practice it. And you are going to get that. With this knowledge, we will solve the problem. You see how beautiful you can solve the problem. Then you can say, sir, I am ready, conceptually ready. You ask me anything, I will solve it. Otherwise, if you learn only procedure how to solve, no? If I teach you how find the present value, do this, then you get caught there. In the exam, if they twist the question. So I expect today, please go home, learn whatever I have studied. I have already shared the soft copy. Okay, the last aspect of the regular way purchase and sale. Now question comes, when should I pass the accounting entry for initial recognition? Okay, there is a timing of the financial assets. An entity shall recognize the financial assets only when you have become party. Agreed? Now, there is one election. It's only for regular way purchase or sale. It's called a trade date accounting or settlement date accounting. Suppose, say for example, you have purchased shares today from the stock market. Now, when you have to pay? Today you have purchased shares from the stock market. When your demat account will get credited? By union, it is called T plus 2. That means if today you have purchased the shares, on the second day from tomorrow, today's day is closed, no? On day after tomorrow, it will get credited to your account. When you have to pay money? T plus 2. Today if you have purchased, today only you need not pay the money. You will pay day after tomorrow. This is called a T plus 2 settlement. Sorry? Payment of why? I didn't get the share only. Why I should pay right now? First we have to order. It's like a placing an order. Today I place. This is called a trade date. And this is T plus 2 is called a settlement date, on which the delivery is going to happen, on which you are going to make the payment. You have to keep a margin, no? That's why based on that margin, this guy, broker will permit you to place the orders. So can go and just tell me one thing. Can you buy 1 lakh L&T shares? No. Broker will stop you. Baba, who are you to buy 1 lakh? First you make one, keep me security and then you buy. So every payments are routed through the brokers. So on T plus 2, you have to make the payment to the broker there. He will call you. Sorry? That depends already how much margin they will permit you and all. Okay, based on that the transaction happens. Okay, this is called a T plus 2. T plus 2 means when you are going to pay and when you get the share. Tell me, are you going to get the shares? No. If you are not going to get the share, why you have to pay today? You said you deliver, I'll pay. Okay, now regular way purchase or sale, it says that look, it's a purchase or sale of a financial asset like shares. Under a contract, obviously, terms require the delivery within time frame T plus 2 established by regulation, say stock exchange. What it says, we will solve the problem on this. Only one question is there. It says that you have got an option to pass the entry today or on the settlement date. See, that means today you didn't pay cash also, you didn't receive shares also, but you can pass an accounting entry where buyer will recognize the asset. You pass account shares account debit to broker or that party account. Today you didn't receive any shares, but you pass the entry. And seller will pass an entry buyer account debit to asset to profit. If you do it on settlement day, that means T plus 2, that means on the day you place an order, you don't pass any entry today. you will pass the entry only when the asset is received. You pass an entry, bank shares account debit to bank, no seller. And seller will pass bank account, no, sorry, you will pass shares account to bank. You will say bank account debit to shares to profit. That means if you do it on a trade day, you have to recognize the payables. But if you do it on settlement day, no payable. Straight away you pay the cash and recognize. So the classification of the financial asset, financial liability, etc. has got no impact on the initial measurement value. Fair value measured on the initial recognition is same on all the three classifications. So in the next, when we solve the problem, I'll explain you this theory again. Okay.